Hey, good morning, everyone. It is 8:01 on Tuesday morning, and we're going to dive into real estate trends for the Denver metro market. So, my name is Chris Lopez. I'm the guy waving the camera in the light blue shirt. So, I'm a realtor at Your Castle Real Estate, and I have Charles Roberts with me. He's the other gentleman wearing the green shirt, and he is not only the president of Your Castle, he's an active agent and also a very active and successful investor. And what we're going to do today, we try to do a webinar about once a quarter with updated trends for what's going on in the real estate market. So, and this is one of Charles's favorite classes to teach. And frankly, he's known for this class all around Denver and gets asked to teach it all the time. So it's great data. And if you guys have seen this presentation before, this is going to be a slightly different one than what you've probably seen in the past. It's going to combine some of the general trends we do and also bring in some multifamily as well. So we can just have a comparison of, condos and homes and duplexes versus some of the bigger stuff. So it's going to be very interesting. And please, if you have any questions, ask at any time in the chat box. We will be monitoring those and answering those in real time. So, Charles, good morning. Thanks for joining us.
Thanks. Great to be here.
So, I see your PowerPoint slide. Take it away. Jump into the trends. What's going on?
Okay, so let's dive into Metro Denver real estate trends. Interesting, exciting market, something we love to talk about. So important to see where we are in our market. And what we like to do at Your Castle, what I like to do personally, is really think about the market and then use the data correctly and effectively. So I always say things like, this stuff is like half science and half art. You can't take a slide and say, that means I should do this. You have to look at it holistically. And we want to look at it patiently with a big picture to say, okay, a broad brush, what is happening with this market? How should that affect our interests? Are maybe we're a real estate agent or a seller or a buyer or an investor in Denver or an investor out of town. Should you, if you live in Detroit, should you buy in Denver? Should you buy here? So what I'm going to do is I'm going to walk through and give you in the next few minutes an overview of our market. And again, as Chris said, please jump in. We love questions, love trying to answer. This is your time, so we want you to get everything you can out of it. So let me begin with this slide right here, which gives us a snapshot of what has happened in the trailing 12 months. If you look at this box here, to give us an idea of where our market is and how it's compared to a year ago, so we can see if there are any trends going on with the market. So what this says is, this is 2018, April 2018, and this is April of 2017. So for example, we have a few more active listings. We're up 4.6% in listings versus last year, which is considered a good thing. Why? Because a balanced market in an MSA of 3.1 million people, which is what Denver Metro is, would be
What's
somewhere.
an MSA?
Is a market statistical area, a metropolitan statistical area. Am I right about that? Yeah, look it up. Go on Google. I think it's a metropolitan statistical area. Thank you so much for actually testing me at 8 o'clock in the morning. And that's called an MSA. It's a fancy way of calling a city, something like that. And we have about 3.1 million people. In a balanced market, it's important to understand this perspective, is about 16 to 18,000 properties of the market. We still have 5,000. So while we have a few more, 4.6% more than we had in April of last year, we actually are a very, very, very tight market, because 16 to 18,000 would be balanced and we have very little inventory. So important to understand that perspective. Under contracts are about the same. New listings. Sold listings is actually down though. We actually have fewer sold listings than we had a year ago. What that suggests to me is that we have a lot of stale properties on the market. So even though we have more properties numerically on the market, the number of solds is down. We know we have lots of buyers. It's just because there's a lot of properties where people are trying to get a price that they just can't get, because they figure, why not? Let's give it a shot. Total days on market, excruciatingly low. So a balanced market, 4 to 6 months of inventory, equating to about 90 days on market. We're at 20. We're actually down 9% from a year ago, from 22 to 20, just as hot a market as you can ask for across the board.
So back up a few sentences here. You said in a balanced market, it's 4 to 6 months of inventory, but 90 days on the market.
It's actually,
can you explain that a little more?
Yeah, so 6 months of inventory. So the way it works is 6 months would be 180 days, but the average would be 90 days. meaning one sold in 1 day, one sold in 180 days, and the average is 90.
Okay.
Yeah,
Okay.
nobody knows that. Everybody gets that confused, which is why I said it the way I said it. But you hear 6 months is a balanced market. That actually equates to 90 days, because the 90 days would be the average days on market.
And so it's really 90 days then. Is
6 months of inventory,
okay.
meaning it would take 6 months to clear out all the inventory, means that the average is right in the middle, which is 90 days.
So is that from when a property goes live on the MLS to when it goes under contract, or when it actually closes? Is it's measured by? Do you know?
When it closes.
Okay.
I think so. Yeah.
Okay.
Yep.
Very cool. Thank you.
Yep. And it's actually, I should also say that it's different. For example, in the Fort Collins market, it's actually different. So it's measured. So if you're outside of the Denver metro area, it actually can be different. So you can't actually say that everybody measures it the same way. Amazingly, different MLSs measure it differently.
Huh. Okay. That's very interesting. And so just for my benefit and else's benefit, like give us the general, like loose definition of what actually the metro is, like geographically.
Like the Front Range, we call it the 7 counties. So it would be down towards Castle Rock, up into Broomfield, Boulder, something like that. So it's the Front Range, up as far as Boulder, Broomfield, Longmont.
Okay, so Castle Rock down south,
Yeah.
up to Broomfield, and the mountains.
Longmont, yeah.
Okay.
Yeah, and then stopping at the mountains.
Okay.
Yeah, but Jefferson County would also include Jefferson County.
Okay, good to know.
Yeah, it's what we call the Front Range here in Denver. Yep. And then, so the median sold price. So the result of very few properties on the market and the strength of this market is that the median sold price went up 9.7%. The average sold price went up another 11.3%. I'm going to show you in the next couple slides a little bit of history on what the prices have done, but just having tremendous gains. And this has been the market we've been in for quite a while. A very, very strong market. Lots of people moving here. Construction picking up, but still not in any way satisfying the need that we have here. And I'll show you a lot of slides getting into that a little bit more. Okay, so let's pop now into the next one, giving you a historical context here. This is Denver metro home prices from 1971 to today. Gives you a real broad brush. Prices go up, had some tough time in the 80s, and then they went up for about 16 or 17 years, just straight up in Denver. And then we had a crash, and I lived through that crash. I had 29 units that I owned, and it was tough. Prices went down 25%, went down about 40%. My best guess is that's what happened with my portfolio. We went down for a couple of years, bottomed out in about 2009, and then this is what we've done since then. And it was really 2012 when the market just started going up and started going up forever, and that's where we are right now. This is the end of 2017. Very, very strong market. And the question everybody asks, of course, is, is the market going to crash? 7-year cycle, all these sorts of things. And all I can tell you is that I'm going to show you more data that suggests to me that I don't see any turnaround in the market anytime soon. It certainly doesn't mean that it won't someday slow down or start to go down or even crash. I'm not saying anything like that. I'm just saying I look at the data and I try to interpret it, and nothing about this data is suggesting to me or any of the folks whose opinions I respect suggest that it's going down anytime soon. I wish I could call it. I'd love to tell you I know when the market's going to turn, but I actually think we're several years out. My best guess.
So kind of jumping here for a second, Charles, and everyone bear with me. Like I said, we're testing a new webinar platform, and I just want to actually test something on your screen here, Charles, see if we can make the graph bigger for everyone. So let's see here. If I can't get this worked out in a couple seconds, we will definitely stop it. All right.
Definitely don't want that.
I know. Poor guest, huh? This should look a little better now. Can you go into full presentation screen on there? Yeah, if you're able to do that, that's going to be better for people to see.
Okay, so we'll continue there. Now let's look at the condo townhome prices. What we saw before were single family homes. This is now attached condo and townhome prices. And what I want to show you here is how similar they are. What you see here is quite similar. They went up, went down during the 80s, went up for 15, 16, 17 years, went down, and have come back up and come back screaming back up. So the single family homes have behaved all in all similarly to the attached townhome and condo in our market. This right here is a great slide that was put together to give us an understanding of how the inventory in the market has changed over time and how that is what I think is the number one metric we should be looking at when we're trying to understand what markets are doing. So if you go here, what you see is that this is January 2007. We had 25, 26, 27 properties on the market, 27,000 properties on the market in 07. And we were selling, 4,000, 4,500 peak. And this is seasonality right here. So in the summer, we tend to sell more homes, and you see that every year. What you see here during the downturn, of course, was a ton of inventory versus properties sold. And then you see here that begins to change, that the inventory starts to get soaked up. And it was 2012 really when our prices started to go up. And why? Because there was no inventory. That's exactly why. And what we thought was going to happen is that it would stay for a low inventory for a year or two, and then eventually it would bounce back up and be some sort of bell curve. And we were all wrong about that. It turns out we now have had 5 going into 6 years of virtually no inventory. Almost literally, we have months, literally, where we have as many sales in a month as we have properties on the market. And look at this. It was really about 2012. We're now into 2018. And by the way, I'm sorry, this actually is cutting it off. This is 17. So there's a whole more year here. And I just chose the wrong slide. Sorry about that. But right here, it's the same exact thing all the way into 2018. I'll send you the updated slide.
So it just goes up and down.
It just constantly, we're right back. April of 18 is exactly the same numbers, which is just incredible. And what it shows us is that the market is continuing to stay strong. That's what we interpret from that. And what we see is that these things, people love to sort of read a newspaper and think they know what's going to happen tomorrow in the real estate market. And the more you do this, the more you realize, boy, things don't generally change that fast. When they do, it makes news. If Tacoma market crashes tomorrow or something like that. But in fact, real estate markets tend to not behave that way. They tend to be much slower, changing over longer periods of time. We're now, since 2012, we're 6, 7, 8 years into this upturn. And if you ask me, I actually think we're going to be in this upturn for a number of more years. And I'm going to talk more about why that is. And this is one of the things we like to look at, which is the showings per active listing per month. It's a metric that we came up with a number of years ago. 2010, for example, what we had, let's say you have a city with only 10 listings, and let's say you have 100 showings over the course of a month. The average listing would have 10 showings. That doesn't mean anything until you have a month when you have 12 showings per listing. And what that means is you have some combination of more people looking for property, buyers, or fewer properties on the market, sellers. And that just means the higher the number, the more demand. So what you see, this is a great proxy for understanding the market. In 2010, we were still kind of in the doldrums of our market. We had 5, 6 showings per listing. But in 2012, that kind of breakout year, wow, we almost doubled. We have 12, 13, 14 showings. And then it really went up a lot. 2015, a very, very strong year, this purple line. And then 2016, we had this weird situation here that I wish hadn't happened, but it did happen. We have no explanation for it, but for a couple of months, we just had this crazy number of showings. 2017 is this yellow line, and we ended very strong. But it is interesting to note that 2018, the first couple of months of 2018, we had once again record high number of showings per listing per month. The last couple of months, it's actually gone down a little bit. So there are people who are going to interpret that as the market softening, and it's possible. I don't know. I simply don't know. I think that we just have to look at it for a longer period of time. If this begins to really go down, well, we'll look at that seriously. It is the lowest it's been in the last 4 years. It's the lowest of 4 years. It's not what I'm saying. I was out, Chris and I were out all day Saturday looking at properties, and boy, there's just not a lot out there. But could this be the beginning of a market trend, of the market turning? Yeah, I suppose it could be. I've seen it too many times where a piece of data comes out and we misinterpret it and we think we suddenly know what the market's going to do. So I'm very reserved about that. I'm very cautious and careful not to make that big statement. But I will note, and I wanted to put this here specifically because I was actually surprised by this. It was actually lower than I thought it would be.
So there are, some people saying even just with those 2 months, so it looks like March and April of 2018, those 2 months of a little bit less showings per month data. Some people are saying that's the the market starting to soften.
Yeah, I don't want to accuse anybody, but you look at that, and someone who believes this is going to happen might use this data, and the fact is they may be right.
Yeah,
I want to be careful here. I'm just saying, you and everybody else is not smart enough to take a month or two of data, in my opinion, and bet the farm. Like if someone wants to bet me $1 billion, I'm willing to bet $1 billion because I don't actually think that's what's happening here. But I'm also humble enough to know it's possible. And this is what it would look like if the market was going to turn. But honestly, I don't know. Check back in a couple of months and we'll keep on top of it. That's what's so fun about this. But this is surprising. The first 2 months were record high. And now the last couple of months, here we are here. It went down quite a bit. That's not something I saw coming. I can tell you that. Yeah. So I like to talk a lot about affordability because it's something that is in the media a lot. It's on people's minds a lot. And it is a very, very important topic, both in Denver and outside of Denver, as prices of homes have gone up and as wages haven't kept up. All you hear is that homes are unaffordable or certainly less affordable. And I don't dispute that. They have become less affordable. But what I have found is that people who sell products like a blog or a web page or a news radio or a newspaper, they got to have something interesting and sexy to talk about. And it's just not interesting and sexy if you look at a perspective, a long historical perspective. But hopefully that's why you're listening to this, because you actually want to get a little more insight. You don't want to just be sold a headline. So give me a minute to explain what is happening with home affordability. So what we did is we actually did a pretty deep study looking at the following variables. We looked at the average Denver per capita income, so the average income per household per capita, and compared that to the average Denver home price as well as the average annual mortgage rate to come up with a debt to income. Basically, how affordable, how much money each home is paying, each family, say, is paying to own a home. And the higher number means they're paying more of their income to own a home. So let's look historically.
And sorry, can I ask you one clarifying question? Because you said, comparing the capita income, the home price, and the annual mortgage rate, that's the actual interest rate. So if it's at, back in the 80s, I know it was in the double digits. So
exactly. Exactly. So for example, as your income, the per capita income goes up, that means it would be more affordable, a lower number. As the home prices go up, it would be a higher number, less affordable. And as interest rates go down, it would be more affordable. Those are the three triggers that we thought were the most important elements to determining affordability. So what we did is we did this going back to 1971. And you see that in the 70s, it was around 40 to 50%, 42 to 50 something percent was the average debt to income. But what you saw during the 80s was mortgage rates skyrocketed and it became truly unaffordable to own a home in Metro Denver.
100%.
Yeah. I mean those were the numbers. So people were doing wraps, they were doing this, but we hit a peak right here where there is no question this is unaffordable. And the people who lived through that can, attest to how difficult it was. Why? Not because wages went down, not because prices went up. It was all about mortgage. It was about mortgage interest rates at that time. Eventually, interest rates came down, and you have this long period of time, about 20 years, where we're back to close to that 50%, relatively even affordability. So what happened during our downturn? Okay, here are the 2 points. What happened is, during the downturn, income didn't go up. interest rates didn't change much. Prices went down and homes became very, very affordable. Really simple, right? The prices went down. And the positive to prices going down, if you weren't someone who got caught with a home where the value went down 50%, was that homes are more affordable. So what you read in the newspaper, what you hear constantly is the following: that homes are much less affordable than they used to be. And that is 100% right. What you never hear, though, is that they're measuring from all-time affordability here in Denver. That's the really important thing. And if you're calling in or listening in from a different market, look for this information from your market. But for Denver, it is absolutely true that homes are much less affordable than they were in 2011. However, it's also important to understand that this was the all-time affordability. So where are we now? We're actually right about the 50% mark. So what I'm doing is we're simply explaining why there are still more buyers than sellers. What you hear is that homes are unaffordable, but if they were unaffordable, we wouldn't have more buyers and sellers. So we know they are affordable. And I don't want to sound harsh. I know that it's hard if you're trying to buy a home and prices have gone up. I completely recognize that. But the macroeconomics tell me that homes are still, quote unquote, affordable if people can buy them. And why? Because we're not here. We're here at the 50% mark. That's a really important thing to understand. So you might be saying, well, yeah, but aren't they going to probably continue to become less affordable? I actually think so. Exactly. I do think prices are going to continue to rise simply because we have so little inventory. And there is no question that sooner or later, we will get to true unaffordability. Is it at 60% or 66% or 72%? I don't know. I mean, it's a continuum. It's less affordable. So the takeaway here is that homes are much less affordable than they were, but keep it in context and understand the baseline was the highest level of affordability in our market ever.
So Charles, before you flip to the next slide, like I've seen the slide 100 times, but I've really zeroed in on this peak from 1982. I mean, it looks like 100%, maybe 99%. Like, do you have any more data or anecdotal stories about like what the market was like back then? Like just the inventory, or how much? I'm assuming it was. Yeah. I don't know what type of market it was. Like, I mean, people probably couldn't sell, people couldn't buy. Like, what was the market like? I'm just so curious.
Yeah,
now.
It was very tough. So what we did see, we actually did a study to determine how interest rates changes actually affect the number of homes sold, because a fear is that if interest rates go to 5% or 5.5%, it'll kill the market. So we went back 45 years, and what we found is interest rates under 10% didn't really affect the market much. People figured it out.
So under 10%, which seems like there was a credit card to me.
There was no correlation between interest rates at 7, 8, 9, even 10% and the number of homes sold. I mean, this is just the data. It's amazing.
No,
but
this is
above 10%, there absolutely was. So what you're asking about is in the 80s, when we had very high interest rates, it absolutely reduced the number of sales.
Do you know what mortgage interest rates peaked back then? Because I kind of know it was like 12, 13. I don't really know the hard
16.9%
number.
16.9% in 1981.
Where do you see that at? Is that
right
on
here.
the slide in front of me?
Yep. Mortgage rates peak at 16.9% in 1981. Yeah.
Thank you.
Yeah.
Pointing
Finally,
out the middle of the screen to me.
Yeah. Get you back from your MSA comment. Yes.
Let me drink some more coffee.
Yeah. So it's a great question, because right now people are saying, well, what if interest rates go to 6%? Is the market going to crash? Look, I don't know, but I can tell you the data shows us over time, mortgage interest rates at 5, 6, 7, 8, 9%, there's no correlation between more or fewer properties being sold until you get above about 10%. And that's when we saw a drop in the number of sales. And it truly affected it.
Do you know, like, I mean, so it was fairly non-consequential to 10%. Then once you hit 10% was just like, was it dropping off a cliff?
Yeah, it's not that simple.
Okay.
You know, like I can actually show you, look, I can show you the slide, and the slide is, hey, look, there begins to be a correlation somewhere about 9, 10, 11%. But no,
if we have time at the end, maybe we can bring that up, because I'd
have to find it, which I don't know where it is, but like in the future one, I can do it. All I can tell you is that this is real estate. There's no like, at 10.2%, suddenly everything happens. That's just not the way the world works. What we see, though, is that somewhere in the double digits, it really does seem to affect the number of sales, which is what you'd expect. But I don't spend my life thinking about things like that
Yeah.
because, first of all, we have a long way to go. And secondly, who knows? Maybe this time it'll be different. Maybe this time when interest rates hit 6%, the market will crash. I'm not pretending it won't. I'm just saying I like to look at data to have some support for my opinions. And the data suggests that's not what happened in the past.
Great. That's very interesting.
Great.
So, hey guys, got any questions out there? Post them. I am keeping an eye on the comments box on the webinar and also Facebook.
So this next slide was actually put out by the Denver Post in January of 2018. And I give them a lot of credit because we had been talking about different elements of this slide, but they put it together in a way that was really smart, and they should get full credit for this. So let me talk about what's going on here, because to me, it really, really helps me understand where I think we're going in the next few years in our Denver market. And that's probably why you're on this webinar and Facebook Live, because you want to know that. What we're talking about here is a housing gap. And the line is the Denver area has been adding households meaning people, at a higher rate than housing units, meaning places to live, for a decade. And that is the subject of what's going on. So let's go back to 2001 and let's work through this year by year. This right here is the number of households, meaning, a family or people living in a house, people. And this right here, the darker, and I wish they had more starkly different colors, but the darker green or whatever that is the number of housing units. So what we saw in the early part of the decade of 2001, 2, and 3 is we had more households. We had more housing units built than households. And then after a couple of years here, it evened out. And this is what's really important to understand, that we've had a decade of more people moving to Denver than leaving, of more people being born than dying. And we've averaged almost a 50,000 population increase year after year. And this is what it all comes down to. Now let's look at it by the year. Starting in 2008, we had this number of households added to our market, but only this number of units added, meaning we had 10,000 more households added than we had units added, and another 9,000, and another 9,000. In this year right here, when the market crashed, what stopped? Housing being built. For years and years and years, there was no building, and yet people still came to Denver. So in 2011, for example, we had 21,575 more households added to our market than housing units, and just about the same in 2012. And 2013, what's that? Still 15, 20,000 more, 14, 15, 16. So if you're in Denver and you see a lot of cranes, or if you're in Denver and you see that the number of permits, and this would be a proxy right here, this is the number of permits, this is the number of units being built is going up. But you got to understand the perspective that for 10 years, we have had way more households added to our market than places for them to live. And that's why we actually have a housing crisis right now in Denver. If you're a renter trying to find a place, you know what I'm talking about. If you're a first-time buyer trying to find a place, you know what I'm talking about. We have too many people, both renters and homeowners, looking for too few properties. And that's not going to change overnight. Is it going to be one night? No, I think it's going to be a lot longer. Is it going to be 20 years? No, I don't think it'll be 20 years. But I actually think it's a number of years. My best guess at this point, interpreting this, is it's going to take a while. It's going to take a while to absorb all of these housing households, people, into units, because we're not building enough to satisfy 10 years of an imbalance.
So can I pick your brain for a couple minutes on here?
Hit me.
So what's the definition of a household? That could be like I'll say a bachelor living by himself, or a wife and 2 kids and a dog, like
or 18 kids, whatever it is, people living in a household.
And so so not necessarily the number of people, it's
the average household is 2.35. Like if you do the numbers, it's right around 2.5, but it's a household. So if I'm one guy living in a house, that's a household. If I'm one lady with 4 kids living in a household, that's one household, and the average is about 2.5.
Wow, those are some
Yeah.
amazing
So
numbers.
once again, you hear me use the word perspective over and over again, but perspective is what we need to have so that we can make good decisions as investors, as buyers or sellers or tenants or landlords or out of state investors, whatever it is. This is the beginning of understanding a little bit more to be able to say, in my opinion, what this says is, yeah, I think it's going to take a while. I don't know how many months, another 3 or 4 or 5 years. My best guess is, yeah, I do think it's years out to absorb all of these households that are chasing too few properties before I think our market's going to change. That is my best guess.
Is there any data on where these people are living? I mean, obviously, if more people are moving here and there's fewer households, is it just, hey, people are doubling up in houses,
that's our
or
best
hey,
guess.
you take the basement, I take the upstairs?
Vacancy rates go down, things move really, really quickly, everything tightens up. It's exactly what we see. And of course, the result is the rents have gone up. We're going to talk a lot about that, and the housing prices and the multi-units and everything has gone up. And this is why you don't have to be a genius to understand, if you have this many people looking for this number of properties, it's an imbalance. That's exactly what it is. It's an imbalance. And it's not a pro or a con. It's not a good or a bad. It's wherever you place yourself. But I would say, for example, if you're a landlord in Denver right now, this is the best news I could tell you. This is why you've made so much money the last 7 or 8 years. If you're a renter in Denver, this is the worst thing you could possibly hear. I'm sorry to be the one to deliver the message, but this is why it's relatively hard to find a place. It'll change over time, but I don't think it's going to change markedly. One definite place it has been changing for the last couple of years is the luxury rental market. I can certainly tell you that.
Now, define luxury.
Like really rich. I don't know. Like,
I mean, like
downtown
if I go
new
rent,
builds kind of stuff.
like 3,000
yeah,
plus
like
a month
2,200 for a
rents.
2-bedroom. That kind of stuff, where all the cranes are. It's been actually several years that there's been an oversupply of that market. Yeah,
and
that's
that
definitely been true.
Trickling down the other.
That's
other
a really good
classes
question. I certainly haven't seen it in my market. So I'm more of like B- to C+. So my investors, our investors, and me as an investor, and I just bought another one, bought a condo a couple of months ago. No, not at all. I mean, I'm just getting hammered. We're getting hammered with tenants who want our places. So I haven't seen it trickling down. And honestly, I don't even know if trickling down is the right term. Like, I don't know that it's going to. I don't know that it's not. I just know that nothing's ever quite that simple.
Yeah.
So I can tell you, in my estimation and with my crowd, we haven't seen any change in that. But it's been at least 2.5 years that the luxury rental market has definitely taken a hit. So stuff that was renting for $3,400 2-3 years ago is $2,600, $2,700 now.
Oh, so it's taken a good,
definitely taken a hit. Absolutely. And sure, that could absolutely reach down to the lower end of the market someday. It might very well. And I've seen it happen. I saw it happen in 2002, 2003, 2004.
So we got a question here from Pete for you, Charles. The question is, are housing units just new construction or total inventory available to buy?
New construction. Yep. I don't know if it says it here, but it doesn't actually. It's a good question, Pete. But this is new product. So right here, for example, this is 21,000 additional households versus the previous year, and this right here is 5,000 additional housing units, places to live.
Now, do you know those? Is that like permits pulled that year, or is that actually like, hey, this unit came online?
Yeah, it's a great question.
This year?
And we actually have another graph that we use, which is permits pulled. And I'm going to be honest, I don't know. And I'm looking here to see, because I don't see what it says here. I actually am not sure.
Okay.
What I would say is, if it's permits pulled, then you push it off 12 months. And if it isn't permits pulled, then it's actually that. And I can maybe call Alvo at the Denver Post and ask. However, let's keep in mind, let's not lose the forest for the trees, right? My favorite metaphor. It doesn't matter. What matters is 10 years of a gap. I mean, that really, it says something that I actually don't know the answer, because I quite frankly couldn't care less. That's not the point, with all due respect. I don't know if it's permits or if there's a lag of 12 months, but that's missing the big picture. The big picture is, for 10 years, we've added more people than places for them to live. And that's pretty much the extent of, my intelligence saying, oh, yeah, that explains why we have tenants who are looking for places and why prices are going up on properties, because we don't have enough to sell.
So here's an interesting question from Jim.
Yep.
Jim says, how many total housing units are we short? like the whole like backlog of inventory?
I don't know. I don't know that there is a number. I don't know how close you could get to a number. As a matter of fact, I feel strongly that I don't know that we can get a number. One way would be to divide 3.1 million or so, which is our population, by 2.35, I guess. Do this, yeah. 3.15 million.
Hold on. I gotta find my calculator. 3.5.
0.15 million. I think that's roughly our population. Divide that by 2.35, and that should be the number of housing units that we need. I just don't actually know off the top of my head
that come out to 1.3 million. That's not
yeah.
right. That's
yeah, of course it is. 1.3 million
total housing units we need.
So 1.3 million would be the number of housing units, and I actually can look into this. That's an interesting question. I'm not sure. So we'll look into it and see if we can figure that out, because you're right. I mean, what this is suggesting is we are short a number. It's not, of course, like a number down to like 1 or 10 or 20. It's probably in the 50 to 250,000 units. But what we're saying here is that presumably, if you add up this differential right here, so let's just say it's 15,000 units per year across 9 or 10 years. Maybe it's in the range of 130 to 150,000 units. My guess would be what's going to be required to actually satisfy this demand. And what that means is we have to sort of stop people from moving here, which of course isn't going to happen, because we're still, every year, we're still adding more people than we're adding units. Eventually, we might change to this where we're adding more units than people, and then the whole cycle regenerates. But it seems to me we'll have to see how many people move here versus how much is built. But I don't think we're close to in any way satisfying, let's just call it 100,000. Let's say it's something like 100,000. I don't see when we're going to start adding 100,000 more in this bar than in this bar. See what I'm saying? It's like, I don't know when it's going to happen, but there's no reason to think it's going to be anytime soon. And that's about the extent of what I'm saying is I don't think it's going to be anytime soon. It'll happen eventually. All markets change. Things happen. It'll be something that no one saw coming, but I don't see that happening for quite a while.
Great. All right.
Great question.
All the questions. So keep them coming. Those are really good questions.
So right here is a really just kind of a neat graph talking about what people do. And there's kind of no hiding. You can leave, and move to Baltimore if you want, or if you're going to live in Denver, home prices are the purple and median rent are the yellow. And it's been expensive to live here. We're not yet as expensive as your Portlands or San Diego's or New York City's or Washington, D.C., L.A., Seattle, places like that. But we are definitely, especially for a non-coastal city, we are definitely at the top tier, and there's no hiding from it. It's not like, well, I'm just going to sell my home and maybe rent because that'll be a lot cheaper. The rents haven't gone up. It's really no surprise. They've actually gone up quite correlated here. It's exactly what happened.
Well, I remember at it was an interesting stat when we went to that breakfast luncheon or breakfast learning session. They actually said Denver's now the most expensive non-coastal city. I guess it was for new construction in general. It was just I remember the details.
I think that was new construction.
It was very interesting.
Yeah, but we definitely are. I mean, we compete, with the best cities in the country, which from a price perspective, at least, are all our coastal cities. Yeah. And there's no hiding from it. And it's not surprising. You can't just suddenly buy and, live more affordably than renting. There's a really tight correlation between the two of them.
So Herb has a question here for you, Charles. Does your data indicate the price levels of the new construction? For example, at what levels are they mostly being added or mostly higher end? I'm not quite sure does your data indicate the price levels of the new construction? At what levels that they are mostly being added or at mostly the higher end? I'm not quite sure what the question is, Herb. I'm not
sure either, Herb. So Herb, either give me your email or give me my email. So certainly follow up, because I'm not sure what the question is. I'm happy to check. I don't know that I have an answer either if I'm going to understand the question, but I definitely want to try to address it. So just let us know. I think Chris is going to give you his email or pop it in again. But I'm not sure yet, but we'll try to address that. So we want to talk about the rental market as well and multi-units. And this is just an amazing, amazing graph of what happened with our multi-units. in our Denver market starting in 2007. So we put this together because we wanted to try to track what was happening. We actually put this together during the downturn. And of course, things have changed so much. It's just incredible having actually put this together in 2008 to see what's happened over the last 10 years. So let me tell you what's going on here. The red are 2 to 4 unit properties, duplexes, triplexes, and fourplexes. And because we want to compare 2 to 4 units with multi-units, what we did is we thought this was kind of a clever way to do it. We just do a price per unit. So this says at this point in 2007, if you look here, a duplex was average price of $230,000 because it was $115,000 per unit, and a fourplex was $460,000 at this period of time because it was 4 times 115. And then what this shows are 5 units. So 77 times 5 is 350, 385,000. So the average 5 unit was 385,000. Here's what happened. Prices went from, for duplexes, triplexes, and fourplexes, went from 115,000 per unit all the way down to 72,000. They just got crushed. And I had a bunch of them at the time. I went through this downturn. I saw it. It was very, very unfun. So I have been there. I've seen it. Duplexes and fourplexes actually got hit a lot harder than the multi-units, at least in terms of the sales. One could argue, and there's a lot of speculation here, that the reason the prices don't look like they went down for the multi-units are because they simply weren't sold. Potentially deeper pocket owners didn't have to sell, whereas the little guys did have to sell, right? This is statistics. This is where it gets really interesting. Did the average price actually go down more in the 2 to 4 units, or was it just that people had to sell them? Well, regardless, it wasn't a lot of fun when you saw your inventory, your prices go down 40%, and that's exactly what happened. So we put this together starting right around here because we wanted to track how low it was going to go and how long it would take to recover. And of course, at that time, we didn't know. No one knows. You don't know during a downturn. You think it's going to last forever. Let me tell you, like, step one is you think it's going to go on for 10 or 15 years. Well, it didn't. What happened is it started to flatten out around 2010, and then prices started to go up a little bit. And then similarly to what we saw in the single families and condos and townhomes, 2012 really saw a jump. So we bottomed out at about 72,000. By 2012, we were at 87,000. So that's $30,000 price gain in that period of time for a duplex. But look what has happened since then. You just can't believe this stuff. Look what it's done year after year after year. And our latest data coming into 2018 was the average unit price for a duplex to a fourplex is $238,000, meaning a fourplex is 76,000. 476,000 is the average price of a duplex. And I have a few duplexes.
What did you just sell for your fourplex?
So we just bought one of my guys just bought a fourplex last week on 4th and Dayton, and we paid it was a duplex.
No, he bought the duplex.
Sorry.
Yeah.
So we bought a duplex on 4th and Dayton in Aurora for $445,000.
445.
Yeah, I mean, right on. Just about right on.
So 222.
Yep.
And what was your fourplex?
I closed on a fourplex yesterday. My guy bought it 4 years ago for $365, a fourplex, and we sold it yesterday for $779.
So let's go back here. So 4 years ago, 365 divided by 4. That was 91,000. What year was that?
2014. It was 4 years ago. I think it was 4 years ago.
Okay, so actually a little bit below the average there.
Yeah.
And you sold it for 775?
779 yesterday.
779 divided by 4, so 195 per unit.
Yeah. I mean, right on track.
Yeah, I mean, like that's.
So, I don't know if you guys were investing or around here, like nobody ever could have predicted or would ever have thought that we could get out that hard and that fast. But this is exactly what happened in the 2 to 4 unit market. In the larger multi-units, it did go up. It bottomed out at 49,000. And honestly, it's almost tripled at 141. So a couple things to know here. One, there's a lot of money chasing multi-units, which is why we actually don't buy them very much anymore. Our smaller investors, mom and pops, people with a handful of properties, they might have 100,000, maybe have $1 million, $2 million. Those smaller investors, we really haven't been buying multi-units the last 3 or 4 years. And here's why. That is why, because the prices have gone up so high, that has driven what we call the cap rates, the capitalization rates down. And what that means is you're simply getting less monthly income than other types of properties, which what we have found is condos and townhomes have actually given a better monthly return. And this is a perfect explanation for why we've been buying fewer of these, because the prices have just gone up so much. But if you own any, you know, print this out and put it by your bedside, because this makes you sleep at night really, really well, especially if you saw this crash right here, which I did. I lived through. I had property. I still own these properties. I never sold them, and it sucked.
Now, I don't know if you have a slide for this, but we've talked about this in the past. So, I mean, I can see the prices tanking. What did the rents do?
So the rents, what I saw the rents do during the downturn, and actually, it was actually earlier than this that I saw the rents go down. So it was more like way out here. It was 2002, 3, and 4. What happened was it was easier to actually buy a property, to get qualified for a loan to buy a property, than it was to get qualified to actually rent a property. So what did people do? People bought. And then what happened? They all lost their properties. I mean, that's basically what happened. So it was the earlier part of the decade, 02, 03, 04, 05, where we hit 12, 13% vacancy rates. At that time, what I saw was a couple of things. One, my rents went down, but they didn't go down 40% like the prices went down. They went down 10 or 15%. They absolutely went down. Vacancy rates went up to 13%. You had to work really, really hard to find a tenant and keep them there, because the tenants had the upper hand. They were slapping us around. That's the way it worked. But it's important to understand that in the worst rental market we have in recorded history, 13+% vacancy, rents only went down 12, 13, 14, 15%. By and large, they didn't crash like the prices did. And of course, they've come screaming back in the last 4 or 5 years. Rents are up about 45%. So they've come back really strong in the last few years. So talking a little bit more about multi-unit cap rates in Denver, this was taken from an appraisal that was done on a 30 unit of a colleague of mine. And I was just, having fun reading through a 112-page appraisal. And I saw this and I'm like, ooh, I want to pull this out. This is great, because this actually talks about the property, the subject property that we did the appraisal on. And these are the comps. And what the appraiser said is the subject property was rated as the average rate from the listings, which was 4.86%. So you need to know a little bit about cap rates to kind of understand the context here. But what this is saying is, for example, this 8 unit had a 5.86 cap, a 5.9 cap, a 5.76, and that is a relatively low cap rate, meaning low cash flow, meaning high prices per rent. Why? Because there's so much demand for these properties, because people want to buy them in Denver. They want to hold these. They believe in the Denver market. What we have done as little investors and real estate agents trying to advise our clients is, for the most part, we're staying away from these just because the cash flow isn't big enough. And like I said before, we're buying more condos and townhomes, which simply throw off more cash flow per month. And then this is the same thing. Capitalization rate summary. Once again, it's in the 5s, and we like to buy in the 7s for a cap rate. And what that means is more cash flow per dollar spent. So if you buy a property, you're getting more monthly cash flow when the cap rate is higher. And this is why we have typically not, the last few years, been buying multi-units, because the cap rates are so low simply because the prices are so high. It all relates to each other. And this right here is a great chart from the Apartment Association of Metro Denver. And what we do is we take 2 different charts, we put one on top of the other. And at the top, you see we have the vacancy rate by quarter. At the bottom, we have the median rent by quarter, so we can see the correlation. So you see over time, vacancy rates go up and down and up and down. But look at the correlation. When vacancy rates go up over time, rents flatten out or even go down. And again, not for a week or a month or a year. I mean, it tends to work in decades. Decade, 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 and decade. Not
so
exactly.
Is this a new theory that you're putting together here now called the decade median rent theory by Charles Roberts?
It's really not. But anybody can see that, boy, it does seem to go in long periods of time, which once again, this is why when someone reads an article in the paper and suddenly thinks the market's going to do this or that the next day, I can just sort of tell they haven't done this for a while, because it's so instructive to understand these things work over long periods of time. So call it what you will. I think it's more of a decade type of thing. So vacancy rates go up, rents are low. Vacancy rates come down. Look at rents go up for 12 years. Massive rent growth. Why? Because we have very low vacancy. Not rocket science.
Now, I mean, were you? I don't know how in tune you were with the rental market in the '90s, and was there the same outcry about housing not being affordable back then, and the rents are crazy? And
yeah, that's a good question. I don't know. I don't think I was paying much attention. I bought my first duplex in '98, and like everybody else, I was just flailing, not knowing what I was doing. And so here it is, '98. I had a couple of good years, right? Boy, I thought real estate was great. And then I owned a whole bunch of properties, and the rents didn't go up for 12 years. And that's the reality of real estate is, tough to predict. We had high vacancy rates here. They still remained somewhat high, and rents didn't even keep up with inflation, not even close, from basically say 2000, 2001 to 12 or 13, a long period of time. Believe me, no book ever instructed an investor and told them that rents wouldn't go up for 12 years, but that's what I lived through, and that's what a whole bunch of us lived through. So then what you see here is, excuse me, vacancy rates went down for a period of time. And there's, of course, a correlation between these low vacancy rates and then the rents skyrocketing. So the rents went from the average of about $900 a month to over $1,300. I mean, that's about 50% over this 4 to 5 year period of time. But it's also important to understand the perspective that, yes, just like with home prices, while rents have gone up a lot in the last few years, they've only actually gone up about 4% over time, which, by the way, is just about what the average income in Denver has gone up over the last 45 years. So the last few years, there's no question that rents have outpaced wages. No question. And that's actually why it looks like it's starting to even out here. But over the long period of time, actually, rents haven't outpaced wage increases.
It's just go in spurts, huh?
Yeah. And that's what we talk about here. So this is a really interesting kind of a, lot going on in this chart, but give me a second to walk through it. What you see here is that the gray is the average weekly wage. The, what's that? Yellow mustard is the average home price. And whatever color that is the average rent. So let me focus on the average weekly wage versus the rent. And so what you think is true is absolutely true, is that for the last bunch of years, wages have not gone up and rents have gone up and home prices have gone up. It's exactly what we're saying. I'm not trying to hide anything here. I'm saying you're exactly right. Of course, home prices and rents have completely outpaced wages. And it's exactly what we're saying here.
So, I mean, do you have any idea? Because I know, like, if prices go up by 10%, even if you're putting a 5% down, your down payment, is much more. Down payment is still relatively lower.
Yeah,
it's not 10% greater. Your monthly payment's usually not 10% greater. Like, how does that all factor in there with like the interest rate and the leverage side of things?
First off, I don't know, because there's so much going on there, but it's muted. It's not like if something goes up X%, then Y is going to happen. It's much more complicated. And what I don't want to do is patronize and just show you like a graph that says, if this happens, this will happen. That's what someone says who's selling you something. I don't hate to say it. It's true. You go to the conferences, or you go to the gurus, and they're selling you something. So they give you information that is appetizing because it has an answer. The reality, fortunately or unfortunately, is this is the real world, is that things take time and there is not a black and white answer. And that's why this is the message we like to get out, is that if you're looking for door letter A or door letter B, go somewhere else, because that's just baloney. The reality is things take time. And this is a really good example of that. So you could, for example, have said right here, oh my God, wages haven't kept up with rents. That means rents have to go down in 2015. Well, you would have been incredibly wrong. And you would have been wrong for years. It's not that easy to predict. But the big picture is, This just can't keep up forever. We know that. And coming here, you're looking at this incredible rise, but look at the last year or so. It's maybe starting to even off as vacancies maybe start to tick up. We're going to look at this closely, but that doesn't mean any impending doom. It doesn't mean anything impending anything except perhaps a change in this trend that's been going on for the last 5-6 years. And that's it. Stay tuned, wait and see. And I think that's, oh yeah, okay, so this is the last one here. So a lot going on in this slide, but once again, let me just concentrate on two things. Let's look at the dark purple. This right here is the Denver average rent for apartments in real dollars, not taking inflation out. Okay, it's with inflation. That's the rents that have gone up. And if that's what you saw, you would say, oh my God, Denver's so unaffordable. Rents have gone up so much since 1981. And you're right, they have. But you would be completely missing the reality if you didn't look at the Denver per capita income. And look at that. That slope is almost exactly the same as that slope. What does that mean? Is that rents as a percentage of per capita income have gone up and down over time. What you hear today is true, just like home prices and affordability. You hear that rents are much less affordable or unaffordable. And they absolutely are. Why? Because in 2011, rents were as affordable as they've ever been in our market. And of course, since then, wages haven't kept up with rent increases. So here's where we are right now. Rents have skyrocketed, wages haven't. Rent as a percentage of income absolutely has become higher. And we're actually at this point now past what we consider the 40-year average. Yeah, rents are actually expensive now. And sooner or later, as this goes up, rents probably are going to need to tail off. And guess what? All these charts come together because that's exactly what we think we're seeing here. We think we're seeing rents not going down, but instead of going up 10% a year, maybe going up to a more long-term average of 3, 4, 5, 6% a year. And as this gets higher, as rent as a percentage of per capita income continues to go up, we would expect rents to not continue to go up. And that's how we bring it all together. And that's exactly what I think is going to happen over time.
So to put you on the spot with the crystal ball you have sitting next to you there, I mean, should I buy investment property today, or should I wait for the market to tail off here, Charles? What's your crystal ball say?
So my crystal ball says that you should ignore the last hour of your life and not really look at this stuff. Literally, so I bought another property 2 months ago. So, full disclosure, I bought another one. It was a good deal. I bought it. So I understand this stuff, but I think I understand it well enough to say I'm a long-term investor. What I truly believe is that you should figure out what level of risk you want to take. If you're a short-term investor, I think you're taking more risk. If you're a long-term buy and hold investor, I think that it makes great sense to buy properties in Detroit, Baltimore, and Denver. If you're going to hold for the long term, the numbers suggest that real estate is a great investment. The best advice I can give folks is to, talk with a professional, come talk to us, come talk with a realtor, talk to your loan officers, but have a long-term plan. And I love the theory of dollar cost averaging, because while I understand the markets, I don't try to time markets. I don't. I think it's just a terrible idea. And I think most people who try to time markets lose money. They think they're much smarter than they are. The best thing I could say is maybe what you do is you say, I'm going to buy a property every 18 months, and just buy a property every 18 months. And they'll go up for a while, they'll go down for a while. But in the end, you probably will do really well. And because Denver is such a desirable place to live, because we're expecting to add another 500,000 people to our population in the next 10 years, and we already don't have enough housing for them, I'm pretty bullish that my properties are going to go up in price and I'll make a lot of money.
So when you bought your first place in 98?
Yeah, I got married in 97, bought a house in 97, and then about 6-7 months later, bought my first duplex. Still own it.
When you bought that duplex, how much of this data did you know back then?
How much what?
Of this data did you know back then?
I couldn't spell real estate. I think I spelled, real estate with an I or something. I don't know anything. Yeah. And that's not good or bad. Maybe it's bad. I don't know. I don't know what it is. That's a good question. I've never actually been asked that. I knew nothing. I read one book on real estate and thought, maybe I can do this. And, that's it.
Great. Well, if you guys got last minute questions, pop them in here. We will start wrapping up. And for anyone out there, whether it's your first time webinar with us, or I know we had a couple people watching on Facebook as well, but if anyone out there has been with us on past webinars with the old platform, If anyone out there has some constructive criticism on or comparisons for how the screen looked or our audio quality, please shoot me an email. Like I said, we are testing all new equipment, testing some new webinar platforms. We want to really up our podcasting webinar game this year. So we're starting to test some new stuff out there. So any feedback is appreciative from your perspective as a viewer, as far as, hey, this worked really great, but here was the issue. So if you got any feedback, ideas, or even compliments, hey, this was better than the old one, I would love to hear it. Just drop me an email at chris@denverinvestmentrealestate.com. And we have a couple more webinars coming up here. Next Monday, May 21st, we are doing a webinar at 4 p.m. Mountain Time called Buying a Deal in Denver. So the trends are a great place to start off. So you have the basic foundation, and then we are going to be actually doing some deal analysis and looking at a couple past deals of a single family home and multi-unit. Your email is live, just so you know. Don't forget.
Oh, so I'm looking at my emails now. Okay,
so
I wasn't paying attention.
So are the other 20 people out there watching this. So just in case.
I was just trying to catch up.
Yeah,
okay.
I understand. Yeah. Great. Well, Charles, thank you for your time. I just saw your email box. I know you got some fires to put out.
Yeah, exactly. Yeah.
But everyone, thank you for coming out. I appreciate your time. And Charles, thank you. I appreciate your time.
Thank you. See ya.
So how do I end the event? And